Now, in this video, we're going to be doing something very simple. I want to show you how you can turn a $100 investment in Bitcoin to earning over $30,000 for yourself with this particular strategy I call the dollar cost averaging strategy. Now, this is a particular strategy that most people, especially beginners in crypto, actually used to build their investment portfolio in this particular space, especially in a way that they don't want to be hurt by how the current market is, exploding and also dipping at different points in time. Now, when you look right here on my screen, you can also see that this is a sheet that helps me track my investment in Bitcoin over the past couple of months. And obviously, I'm actually willing to turn this into thousands of dollars myself with that little budget that I have. Now, this obviously means for you that whether you are new to crypto or you have been around crypto for a while, the DCA strategy is a powerful strategy that helps you avoid market timing stress, reduce risk, and build your wealth in cryptocurrency consistently. In this video, I'll break down the step-by-step process of using DCA in real-world example and also show you how you can start today with as little as $100 investment every single month. Now, make sure you watch through this video to the very end so that you get all of the info that I'm going to be sharing with you guys here and understand how this works and how you can also leverage on it for your investment strategy going forward. Now, your major question right now is, what is DCA? Now, DCA, dollar cost averaging, is an investment strategy where you invest a fixed amount of money into an asset like Bitcoin or Ethereum at regular intervals, whether it's daily, weekly, or monthly. Now, instead of trying to predict when to buy, when to sell, when to hold, when to do this and all, DCA just helps you to spread your purchases over time, smoothing out price fluctuation and also reducing overall risks for you as an investor. Now, this method is particularly used in volatile markets like crypto, where prices can actually just change dramatically within a short period of time. By using DCA, you're going to avoid the stress of market timing. You're going to build your portfolio gradually without worrying about short-term price dip. You're going to reduce the impact of sudden crashes or spikes, and at the same time, you are going to be able to build a very solid crypto portfolio with consistency in the game. Now, why exactly should you use DCA in crypto? Now, crypto markets are obviously known for their extreme volatility. Now, prices can actually swing from 20 to 50% in a matter of days, and trying to time the market often results in buying at the wrong time. Now, here are a couple of reasons why DCA is a smart approach. It reduces emotional investing, where you get to avoid impulsive decisions based on hype or fear. It minimizes your risk, where you spread your risk across different price points and also gives you long-term growth. Historically, Bitcoin and other strong cryptos have shown long-term upward trend. A very good example here is, let's say you started investing in Bitcoin with this DCA strategy around 2020 when it was at around $8,000, and you continued through its ups and downs. You will have actually still averaged a favorable entry point despite reaching the highs of over $60,000. Now, how do you get to implement the DCA strategy right now? Now, the very first step here is to choose your investment amount, right? This is where you get to decide how much you can comfortably invest. So you might actually want to start with, let's say, $50, $100, or even $500 per month. Now, with this, you want to ensure that this amount is something that is within your budget and would not affect your daily expenses. Okay? Now, once you have this checked, the step 2 is to pick your investment interval. Now, you can actually choose to invest weekly or bi-weekly or monthly, whichever one actually suits you with your investment budget. Now, a very good example here is where you're investing $25 every week instead of $100 once a month. This obviously helps you to capture more market fluctuations within that span of 1 month. Now, step 3 here is select your cryptos wisely. Now, in this case, you want to focus on projects with strong fundamental and long-term potential, such as BTC, or maybe Ethereum, or layer 1 and layer 2 solutions like Solana, Polygon, Avalanche, or maybe even DeFi projects like Aave, Uniswap, and other projects in these categories. Okay, now the fourth step here is where you now want to choose to automate your investment. Now, in this particular case, you actually want to leverage on exchanges like Binance or Bybit that actually allows you to set up recurring buys to make your DCA strategies completely hands-off. Because the easiest way to go about this is to easily just, automate the full process. Now, let's quickly look back on my sheet and let us break down what can happen when you use DCA over different time frames. Now, using the latest Bitcoin price today, and let's say we're forecasting over the year of 2025. Now, the very first scenario is where you're planning for a 1-year DCA investment. And here, your monthly investment, let's say $100, and the total investment you're making for the whole of the 12 months of the year is going to be $1,200, right? Now, the average Bitcoin price is about $100,000 right now, and let's say you've accumulated about 0.012 BTC. Now, if BTC reaches $145,000, your holdings are actually now 45% up, which will actually amount to about $1,740 within the span of a year. Now, if BTC reaches about $225,000, your holdings are actually 125% up, which will now be $2,700. Now, let's say you actually keep on accumulating more coin and you're investing consistently for the next 3 years, for example, till the same $100, you would have actually amassed a total investment of $3,600 within the 36 months. And let's say the average price of Bitcoin is $150,000 and you've accumulated about 0.02 BTC at this particular point. Now, if BTC hits $300,000, your holding are now going to be worth $7,200, which means that you have done 100% of your investment at this particular point. That if BTC actually goes ahead to hit $500,000, your holdings are going to be worth $12,000. That is over 230% of your investment. Now, imagine you're still consistent and you flow through with this for a period of 5 years, right? With your initial investment of $100 and spanning it over 5 years, which is about $6,000 within 60 months. Now, the average price of Bitcoin at $200,000 and an accumulated Bitcoin of 0.03 BTC. Now, if BTC hits $500,000, the holdings are worth $15,000, which is 150% of your initial investment. Now, if BTC goes ahead to hit $1 million, your holdings are now going to be worth $30,000. Now, you can obviously see here that we've turned a $100 investment into a $30,000 profit being made in this very space. Now, you can actually see here that we've turned a $100 investment into a $30,000 holding within this span of time. Now, let's take a little bit of deep dive and look at the potential risks of the DCA. Now, while DCA obviously is a great way to minimize risk, it is not without its own downside as well. Now, let's take a look at a couple of risks with the DCA strategy. Obviously, yes, in as much as it is a great way to minimize risks, there is actually going to be a couple of potential risks that you might want to be very careful around this very space. And a couple of them are where you are going to be getting slower gains. Compared to a lump sum of investing, your profit may take longer to accumulate. Now, let's also look at fees, because right here, you see where frequent transaction can actually increase cost if you're not using the low fee platform. And also, you're going to be missing on big dips. You may not take full advantage of sudden market crashes because you are leveraging on the DCA strategy. But the major thing here, guys, is even while you are leveraging on this DCA strategy, it doesn't mean that you cannot always go ahead and enter the market at different times with other investments or with other cash you have for investment. You can always still leverage on that particular opportunities as they come your way, which might end up maximizing more profits that you have within this crypto space. Now, I'm going to share with you guys a couple of practical tips to get the most out of the DCA strategy. And this is one where you want to start and you're sticking to a plan. Now, this is actually very important because you want to avoid temptation to invest more during a FOMO-driven rally, right? You want to use portfolio tracking tools, and you can leverage on apps like CoinMarketCap or CoinStat that can actually help you to track your progress. Or you can also diversify your investments, which obviously you know already. Do not put your everything into one asset. Spread your risks across multiple coins and always reinvest your profits. Once you accumulate a solid portfolio, reinvesting profits can accelerate your growth, obviously. Then if you're looking for a stress-free way to invest in crypto and build wealth over time, then dollar cost averaging is actually your best bet. It is very simple, it is effective, and it is perfect for beginners and even experienced investors alike. Now, if you actually found this video useful, go ahead and let me know your thoughts about the DCA strategy in the comment section below. And you can drop this video a like and subscribe to this channel for more content like this one. At the same time, I have a crypto community where I share a couple of information around crypto and also share a couple of free signals that would obviously help you make more money in this very space. You want to click the link in the description to join my crypto Telegram community. And with this, guys, I'll see you in my next video. Peace.